Funds are a cheap and hands-off way of accessing the stock market. So in this video, we're going to learn what they are, how they work, and how you get involved investing in them. And the key concept that we're going to learn about is diversification. Because in investing, there are the types of risks that you need to take in order to get that return. And then there are these unnecessary risks, which you can mitigate by diversification through a fund.
So what is a fund? Well, firstly, a fund is a pool of money, but in investment terms, it's a pool of money that's invested in a basket of investments across a particular area of the market. It's also open for business. You and me as retail investors can go out and add money to that fund. So how the money in the fund is invested is the fun bit, and it can vary enormously. It could be a fund that's just invested in the UK, for example, or maybe in Asia in bonds, or perhaps expensive wine, or maybe green infrastructure. Where the fund invests is decided according to its mandate, which is basically just the rules that say what it can and can't do. And that's enforced by regulation. The regulator in the UK is the Financial Conduct Authority, or FCA. So who runs a fund? Well, it's usually an investment management firm, also called an asset manager. They are the ones who are regulated, and it's just to make sure there's nobody dodgy taking your money and running off with it. Ultimately, we use funds for four main reasons. Firstly, it's a hands-off approach. That means you're not picking investments for yourself. And in fact, in some funds, there's a fund manager doing exactly that job. They've been trained and have experience in picking investments according to a specific mandate. Thirdly, funds can be a low-cost way of investing in the stock market. All that buying and selling, the trading, those costs can soon add up, and funds can go some way towards reducing those costs. And finally, it's diversification. Funds can help get rid of those unnecessary risks when it comes to investing.
So to pick up on Simon's last point there, we're going to focus on diversification because it's a very, very important concept in investing. This idea of not putting all of your eggs into one basket. Because as I said in my introduction, when you invest, you're actually taking two different types of risk. Those necessary risks to gain a return. Simon mentioned some of those flavors a little bit earlier. And then there are these extra unnecessary risks you take by investing in a specific stocks, and they're the risks we can diversify using a fund. Now, if you own lots of different businesses across a number of different sectors, you get rid of those very specific risks to do with that company or being in that particular sector. That's because if the worst happens and something goes wrong with that one particular company, you've got many other companies within a portfolio that ballast it. And hopefully, therefore, your investment in that fund should still do well.
So does this idea of diversification apply to all investment types? Well, the short answer and the good news is yes. We've just been talking about shares. Let's look at another asset class, wine. Let's imagine you bought a single bottle of wine, really enjoyed it, decided to fill your cellar with that same wine as an investment, and then 20 years down the line, you uncorked it and it was terrible. You would have essentially lost all of your money. However, if you'd invested in a wine fund, you would have different types of grape, different countries, different varieties spread across that fund, meaning the one that went wrong, the one that didn't taste very well after 20 years, wouldn't have had a huge effect because hopefully the others would have done well in that time. So being in a wine fund gets rid of those unnecessary risks, and what you're left with is the investment case. And these break down into basically four categories. The first is asset class. So are you going to invest in more risky shares than, say, less risky bonds? Then there's geography. Are you going to buy emerging markets, arguably more risky, than developed markets? And then what about the size of the company? Smaller companies tend to go bust a lot more frequently than bigger, more established companies. And then there's the specialist nature of the investment itself. Is it in a specialist sector, for example, or has it got a specialist mandate that has a very specific objective? So by making a decision on these 4 types of risk, you can use funds to build the basis, the building blocks, if you like, of your portfolio. So if you invest in a number of funds across these different approaches, you're investing in a pretty sensible way, and it should provide you good returns over the long term.
Now, funds will charge for this. People don't get out of bed for nothing. And the way it works in the funds world is you get charged a percentage of assets. It's a percentage of that money that you get put in. You're not going to be sent a bill though. It comes directly out of the assets of the fund, which can be a bit of a stinger because it means you're going to get charged whether the value of the fund goes up or down. Now, the reason why it's an efficient way of accessing the stock market is because when you put your money in that fund, you're effectively buying all those investments within the portfolio. If you were to do it yourself, it would get very expensive in trading fees. So these types of fees plus other costs are spread across a large number of investors, which is why it's quite an efficient way of accessing the stock market.
So what's the downside? There's always got to be a downside. Well, when you invest in funds, as we've explained, you're taking a lot less risk. That means that your potential for returns is more limited. Think about that single stock. It could go crazy upwards, but it could also go to zero. That's much less likely to happen with a fund. So if you want to chuck your hat in the ring and give it a go, it's totally possible to do that. Remember Marcus's point about costs, but also all of those investment professionals out there are doing the same thing and they can get it wrong. It's incredibly difficult to pick investments and find the ones that are more likely to go up.
So we've learned that funds are a very cost-efficient way of accessing the stock market, and they enable you to focus on the necessary risks that you need to be taking in order to earn a return. Things like the asset class that you're in, the size of the company potentially, and also the geography, where in the world that market is in. What funds also do is enable you to diversify away those unnecessary risks that you don't need to be taking. Risks that are more specific to do with the company or the actual sector that it's in. Now, if you want to learn more, we've got some beautiful animations that explain this in a bit more detail. One on investment risk, the other one here on geography. We really hope you enjoyed this show and got lots out of it. We'll see you soon.
Goodbye.